Digital ID is becoming a prerequisite for participation across sectors, including finance, healthcare, government services, and commerce. The EU's eIDAS 2.0 framework, India's Aadhaar system, and various emerging digital identity solutions aim to establish persistent, verifiable identities for individuals and entities. In parallel, the US advances initiatives like the National Strategy for Trusted Identities and Cyberspace and explores federal frameworks to strengthen identity verification and privacy. Similarly, the UK is developing a national digital identity system to provide secure, user-friendly access to public and private services. These digital identity systems embed verification as a gatekeeper to essential services and economic participation. The Financial Action Task Force, FATF, has extended its surveillance through the Travel Rule, requiring virtual asset service providers to collect and transmit identifying information on transactions, originators, and beneficiaries. This subjects crypto exchanges and wallets to the same financial reporting obligations as traditional institutions. Compliance is embedded into infrastructure through standardized messaging protocols such as ISO 20022 that we considered previously. This ensures interoperable, machine-readable data flows. Non-compliant entities face exclusion, and financial privacy is increasingly signaled as suspicious behavior, eroding peer-to-peer autonomy. Legal entity identifiers, LEIs, are mandatory for institutional actors in many securities and derivatives markets, enabling regulators to trace exposures, identify counterparty risk, and map systemic vulnerabilities. The LEI system is expanding into tokenized markets and cross-border finance, where legal entity tagging ensures compliance and traceability. This creates a unified layer of machine-readable identity, supporting automated regulatory enforcement, effectively a passport to participate. Unregistered actors become invisible or non-compliant by default. Environmental and social governance scoring mechanisms now determine capital allocation, lending terms, and reputational viability. Regulatory taxonomies define sustainable activities, and financial institutions incorporate ESG criteria into their credit ratings, investment strategies, and risk models. The scope of ESG is widening to include diversity audits, equity assessments, and political disclosures. This links financial inclusion for individuals and corporations to ideological conformity. Non-aligned institutions and individuals face exclusion or penalties. ESG functions not as an impartial assessment, but as a tool of control. ESG parameters have actually emerged from a fragmented mix of regulators, industry bodies, rating agencies, and private consultants, with organizations like the International Financial Reporting Standards Foundation and the Task Force on Climate-Related Financial Disclosures exerting outsized influence without any sort of democratic accountability. Rating methodologies vary widely and lack transparency, with conflicts of interest blurring objective assessments. Meanwhile, mechanisms to challenge ESG scores are minimal, and proprietary algorithms prevent meaningful oversight. Consequently, ESG acts more as a political instrument than a market tool, creating a gated, controlled economy by unelected bodies wielding discretionary power. Enforcement extends beyond regulators, though. Private actors operationalize these rules. BlackRock integrates ESG into investment decisions. MasterCard develops digital ID verification tools. Microsoft provides infrastructure for decentralized identity, and Palantir integrates data across agencies and clients to create live risk scores, enabling predictive monitoring and real-time intervention. These intermediaries effectively serve as functional regulators, controlling infrastructure, data pipelines, and compliance logic, shifting from rule of law to a rule of code. Compliance-based systems have created a new class of excluded actors as well. Individuals in regions lacking digital infrastructure or formal identity systems are denied by default. And then, of course, there's concerns over the availability and reliability of electricity supply. Moreover, small and informal enterprises struggle to meet AML and ESG documentation burdens. Financial inclusion rhetoric masks a consolidation program. Only compliant actors receive access, while parallel systems are criminalized or deprecated. Opting out means exclusion, participation is conditional, and autonomy penalized. The G20 roadmap to improve cross-border payments seeks to reduce costs and increase transparency. Initiatives like ISO's 20022-based Global Payments Innovation Pipeline and BIS platforms such as Nexus and mBridge link national payment systems. These rely on harmonized data models, real-time traceability, and compliance by design. Transactions will no longer be private. Each payment is a data point monitored continuously. Speed and efficiency justify this apparent surveillance, making the system ideological infrastructure rather than being neutral. CBDCs and stablecoins act as control points tied to digital ID, ESG scoring, and tokenized assets. They enable programmable money with spending conditions set in advance, dynamic rule changes, and real-time access modification based on behavior status or policy alignment. Tokenized markets function similarly. Assets carry embedded rules. Transactions are permissioned. Deviations blocked automatically, and code enforces policy without negotiation or appeal. When access depends entirely on digital identity and scoring systems, especially where private stablecoins and CBDCs dominate, individual freedom risks becoming illusory. Private stablecoins lack the safeguards and transparency of central bank digital currencies and can unilaterally encode restrictions like freezing balances or limiting transfers without due process. Earning, transacting, and storing value without third-party approval becomes sharply limited. Traditional financial sovereignty is replaced by conditional permissions, revoked or granted in real time by algorithms and intermediaries. Retaining agency demands operating outside this system or building some degree of parallel infrastructure, though these face regulatory hostility, of course, as well as liquidity challenges and technical barriers. Self-sovereign identity models may offer choice to some and offer some hope, but they often depend on permission frameworks and private providers. The stark question remains how to maintain meaningful control over your financial life when exclusion is the default unless compliance and scoring criteria are met. Without solution, sovereignty becomes theoretical and certainly not lived. Clearly, all of this is not reform, it is a shift from participation by right to participation by permission. The architecture allows no meaningful dissent or alternatives. It closes the system. For those valuing sovereignty, key questions to consider are: can you earn, transact, and store value without permission? Can you operate independently of centralized scoring or identity frameworks? Can you choose your associations and values without financial penalty? If the answer is increasingly no, what is being built is not a financial system, but really it's a control grid. Despite the architecture of control consolidating power through digital IDs, ESG mandates, and programmable finance, the future is not predetermined. Awareness is the first step towards resilience. For some emerging technologies in decentralized identity, open source financial infrastructure, and privacy enhancing tools offer hope. For others, communities and innovators experiment with alternatives outside traditional systems, from peer-to-peer exchanges to blockchain projects designed to resist censorship and control. Regulatory pushback and public scrutiny of ESG frameworks could help to foster transparency and accountability. Preserving financial sovereignty requires vigilance, technical literacy, and collective action. It demands interoperable systems prioritizing user control and choice over mere compliance. The question remains whether these efforts can scale before the control grid solidifies. In that struggle lies cautious optimism. For even in tightly regulated environments, pockets of resistance and innovation can thrive. The challenge is to protect and expand them. Now, thanks so much for joining me. Do check out the other videos in this playlist, and I look forward to seeing you next time. Bye-bye.